Good morning, good evening, everyone, all of our TGCC participants. Welcome to financial statement analysis. We have with us Pablo Mendoza. You may know him as he was a regional judge for the TGCC North America round recently. He is a technology investor at Vi Capital, and he spends all of his days looking at different companies and listening to pitches for him to invest in other people's companies. So who better than to help us with financial statement analysis than Pablo himself? Well, I will turn it over to Pablo.
Hey guys, how's it going? Good afternoon. Let me share my screen real quick. So question, so I guess taking a step back first, step one, let's make sure you can see the screen. Okay, great, awesome. So hi everybody. To start, I'm happy to make this, I'd actually like to make this as interactive as possible. So to the extent that you guys wanna throw on your cameras and answer some questions, that would be really awesome, just because I think that's a cool way to learn and we can go back and forth, and I'm happy to like answer any questions and we can get a conversation going, and it's good stuff. So I just want to double check. So I guess, can anyone, if I ask a question now, can somebody, okay, how about what day is it? Does anybody want to answer that question? Nobody wants to answer the question of what day is it. Okay, got it. Let's see. Oh, there's chat. Okay, cool. Hi, everyone. September 29th. Thank you, Parsa. That's amazing. Okay, I'm going to keep the chat window here. So you guys can text answers, and I will just talk out loud. Cool. So financial statements 101. For those of you that are interested in learning, it's pretty important, I would say, but financial statements essentially are a way to look at a company. And so for me, for example, I am an investor where I look at a bunch of technology companies and I decide like whether they make sense or not, whether they're doing well or not. And in the same way, when we're looking at companies, financial statements kind of allow you to do that analysis in a way where you can kind of evaluate from a quantitative perspective if a company is doing well, if it's good, if it's bad, yada yada. And so I'll just step through the slides and like kind of give an explanation. So basically, corporate finance 101, financial statements, I'm not going to be able to teach you everything in one 1-hour session because that is literally impossible. I actually highly recommend, if you are really interested and you do want to learn a lot, there's like a link at the end of your packets that you received that has like a really long PDF. But if you were to study that PDF, you would kind of be an expert probably in financial statements. What I want to spend time doing now is kind of talking through how we should think about financial statements, what they really mean, and like why they're important. We're not going to dive too much into the super detailed, in the weeds details, just because it's a lot of stuff that you're not going to remember. And I just want to make sure that this is something where you kind of come away learning a little bit more, understanding a little bit more about financial statements and companies, etc. Cool. So the first thing, starting with the metaphor of a doctor. So basically, if we think about it, operation, or am I old? Can somebody say, like, just text that they've heard of operation so I don't feel crazy? None of you have heard of operation? Okay, cool. No problem. So with operation, basically, it's a doctor game, but the entire point is it's a fine picture. But with financial statements, there's very much a parallel between companies and the human body. So what does that mean? It means that the same way that a doctor kind of does surgeries and does operations and performs different things on humans, you as a financial analyst or an investor actually spend a lot of time moving companies around, breaking them apart, putting them together, and doing like very similar surgeries, right? And so my job very much consists of doing those types of surgeries, but in order for you to like really be able to do surgery and do like, you know, cool financial transactions and invest in things, you really need to understand the body, right? You can't, you know, do a heart transplant if you don't even know what the heart is, right? And so basically, in order for us to be able to actually think of investing or actually use finance in a way that's constructive, we need to understand the body. The body is the company itself. the financial statements in this analogy are very much the heart or the lungs or the brain of the body, right? So they tell you, you know, how much is the company making? How much is the company spending? How much company does the company have left in terms of money? Is revenue growing? Is it growing healthy? Is it not? Do we need to do something to fix it? So a lot of financial statements are just ways for you to understand how the company is doing. Thank you, Mari. Thank you, Mari. Appreciate it. So yeah, so basically what I write in text here, I wrote understanding corporate finance equals understanding the body. Talked about that. To value companies is like doing surgery, exactly, and you need to understand the body before you can operate on it. So for you to be able to actually invest and do financial transactions, you need to understand financial statements. Cool. So the way that I think about learning all of this stuff is there's one key that you really want to get. And that key is you want to understand how different financial statements all interact. If you're able to do that well, then you probably have read your entire PDF and you know a lot about financial statements, because it's not intuitive and it's not easy. But that is kind of what you want to work towards. You want to be able to understand, how do all these numbers connect, and like, how do they all even make sense? And so from there, taking a step back and looking at the statements themselves and how they're interconnected, there's 3 financial statements. And we'll go left to right on the page. And by the way, if you guys have any questions, like, also feel free to put it in the chat. I'm very flexible. Like, this is not supposed to be something super serious. It's just supposed to be us learning together. So if you have any questions, just feel free to post. So I'm going left to right. So the first one is the income statement. So when you think about the body, right, you're thinking about the stationary body and the moving body, right? Like, stationary being is the heart. Does the heart look fine? Do the x-rays look fine? Do the organs look fine? But then there's motion, right? Like, is the blood flowing correctly? Like, do you have like good blood pressure? Is your heart pumping correctly? Are your lungs like operating correctly? And so in the same way, financial statements are broken down into 2 types. One is static and the other is motion. Paints a picture of the company, a spot picture of the company today. The motion are financial statements that show the company's development over time. So what are simple examples? Cash is a static number. Like, you have a certain amount of cash in your bank account. A motion example would be your income. How much money are you making? So cash is a static number. Income is a moving number because it's how much money you're taking in. And so when we think about the 3 financial statements, the first one, which we'll go through, I guess, now, is the income statement. The income statement, probably the most important of the 3 financial statements. Take a step back. There are 3 financial statements. First one is the income statement. The second is the balance sheet. The third is the cash flow statement. The most important, I would say, to understand, and probably the easiest to understand, is the income statement. And so, as I discussed before, this is a motion. So the income statement is, we're checking if the blood is flowing correctly, not if the x-rays look good. And so what happens here is, as a result, income statements are capturing a company's income performance over a period of time. In this case, they are doing it for a year, the gap of a period of a year. And so what the income statement in general will tell you is how the company is making money, how it is spending the money that it is making, and whether at the end of the day, it is making money like net positive over expenses, or if it's losing money, right? This matters a lot because obviously how much a company makes is a huge deal when it comes to its worth, but this would be probably the most important one to learn. And we can walk through in detail shortly, but I just want to walk through high level each one. The second financial statement is called the balance sheet. So the balance sheet is the static statement. So this is looking at the body like in one fat giant x-ray. So it's saying, how much cash do you have? How much real estate do you have? How many buildings do you own? How much do you owe other people? Like, what is your credit card balance? Like, all of these static numbers are shown on the balance sheet. And obviously on the statement, it doesn't say credit cards, but as we go through, and we'll go through shortly, you'll see that a lot of these credit cards in layman's terms are bucketed categories that you see on the page. And we can walk through and talk about which one is which. The final financial statement is the cash flow statement. So the cash flow statement is actually the other motion statement, like the income statement. So it's capturing the way that cash flows in your business over a period of time. In this case, a year. And so what does that mean? Here, we don't care about how the company is doing or making money or spending money. We care about how cash is moving. We don't care about, so in cash flow statement, what you'll see that you won't see the income statement, for example, you will see investments. So like if you have a lemonade stand and it makes $100, you'll see that on the income statement. But if you have to spend $10 to fix, I don't know, a lemonade glass, that is something that won't appear on the ongoing operations of your income statement. It will appear in the cash flow statement. That sentence is not intuitive. I do not expect you to understand that. If you do, you're a fucking whiz, or a fudging whiz, sorry, excuse me. But like I would be very, like, don't worry about memorizing that. So yeah, 2 motion statements, 1 static statement. The balance sheet's the static, the income statement and the cash flow are done over periods of time. I will pause there for a second in case does anybody have any questions? Feel free to put it in the chat. No? Or wait, let me actually see if I can actually check the chat. Oh, I have no new notifications. Just Mari and Parson. Okay. Well, if you have any questions, feel free to post. Yes, it literally is like a list. Parson, that's a great question. So the key word here, Parsa, is ongoing operations. So it's almost like a lemonade stand itself is like a box. You spend money on the lemonade, the sugar, you make money from the lemonade stand, but sometimes you need to inject a little outside cash to upgrade your lemonade stand, right? Sometimes you need to put in $100 or $200 to upgrade your sign. That has nothing to do with the ongoing daily operations of the lemonade stand. It is an external investment that you're putting into the business. So it's actually not reflected in COGS, it's put in a cash flow statement as an investment. Does that make sense? I hope it does. If it doesn't, we can revisit it again. But that's a great question. Exactly, it's not a direct cost, it's an investment cost into the business, but it's not a cost associated directly with the day-to-day operations of the business. You would not upgrade your sign for $100 every single day. You would buy lemonade every single day, or lemonade powder, right? But that is a really good question. Cool, so we'll start with the balance sheet. So the balance sheet is, as we talked about the x-ray of the company, it is almost like a list, and it's kind of telling us from a really high view, taking an x-ray telling you what is this like financial status of the company today, right now, right? And so we can walk through each of these line items and I'll tell you what they are. If you guys don't know what cash is yet, we should have a serious conversation that does not have to do with financial statements, but I'm assuming you do. It's not any different on financial statements here. So cash is just literally how much cash you have in your bank account. Accounts receivable is cash that you're going to get in the near term. So accounts receivable essentially is if you buy lunch for you and your friend and you Venmo charge your friend hasn't actually paid you, so you don't have that money as cash in your bank account, but you know that your friend is going to pay you like in the next week. And so therefore you can assume that it is an accounts receivable where it's an expectation that we will be. And so accounts receivable is everything that's gonna, basically all the cash is gonna come to you in the near term. That's owed to you. Cash is just regular piggy bank. And that is what's known as kind of like your liquid assets. So that's like your piggy bank. The next part after accounts receivable is inventory. Inventory is essentially all of the supply you have that you are going to be using for your business. So like inventory could be number of glasses you have, or number of lemonade tanks, or it could be the number of lemonade, like the number of lemonade signs you have, right? All of these is inventory. Or it could also be product inventory, where you have made $1 million worth of iPhones, but you have not sold them yet. They're just kind of sitting in your factory as you wait for people to come and order them online so you can ship them, but they are kept as inventory. Prepaid expenses don't matter, don't worry about that. It gets a little complex, but that basically gets to your current assets. And so what does that mean? Taking a step back, the balance sheet is divided into 3 parts. The first part are your assets. Assets are what you have. So the technical term for an asset is something that you have ownership over or the right to like basically own. It can be anything from, it's anything you have is the way I think about it, right? So it could be anything from the cash in your piggy bank, to your glasses, to your watch, to your, basically like anything that you have claim to are your assets. The second one are your liabilities. Liabilities is what you owe. And so what is this? This is your credit card bill. This is the student loan you're about to take out. God bless you. All of those things are things where you are given funds up front, but you have to pay them back to somebody. So somebody gives you cash via a credit card to buy lunch. Somebody gives you a big loan so that you can afford college, but you'll pay it later. But they're not assets because you don't own them. They're liabilities because it's a debt that you have to pay back, right? And so if you think about it, your assets are the $10 I have in my wallet. Your liabilities are the $8 that I owe the bank, theoretically speaking. How many dollars does that leave you, are you left with if you pay back? Let's say you have $10 of assets and $8 of liabilities. How many dollars do you have left over at the end of the day when you pay your credit card bill back? So if you pay your $8 liability credit card, thank you, Lena. Hi, how's it going? I really appreciate the response. Yes, you're right. It is 2. That number 2 is your equity. Equity is essentially, so equity definitionally is, yeah, right? Not a hard math problem, but conceptually it means that you're understanding, which is good. So it's not only glad you can math, glad that you can think critically. Good for you. So equity is what's left over. So equity formulaically are assets minus liabilities. So $10 that you have in your piggy bank minus 8 that you owe equals $2 of equity. And so equity are the assets you have left over after you've paid off all your liabilities. So all it is if I were to pay all my debtors today, right? How much money do I have left over? That would be my equity, right? Those are the 3 big portions of the balance sheet. So assets, which we're talking about, are there GAAP rules for assets like buildings and inventory worth, or is it just what the company says? That is a great question. There are GAAP rules. So what you would do is you would hire an auditor who would classify all these. What companies like to do is they have adjusted numbers where they take these GAAP numbers and then they change them to basically show the numbers they want to show. Whether an investor wants to believe that or not is up to the investor, but the investor knows that it's adjustments from the company that are going outside of GAAP rules. So it's always a little risky. But you're right, there are GAAP rules, and it is very, very standardized into how these things are categorized, which is why I can tell you inventory are the iPhones. I can tell you immediately, you know, this is real estate. I can tell you immediately depreciation has to do with like the whatever. Point being, they're specific enough that you can kind of, you're right, you can kind of start picturing the company in your head by just looking at these numbers. You can start picturing, oh my God, they have a lot of buildings. Oh my God, they have a lot of phones. Oh my God, they have a ton of cash. Like, what are they doing with all this cash? And so you start connecting the dots, and it's important because then it helps you start painting a picture of the body, right? And the more detailed picture you can paint, the more you can understand the company. Thank you for asking, Farsa. So cool. So we're going through assets. Other assets are obviously real estate. You own real estate. Now, here's a question. Is a mortgage an asset or a liability? So let's say I buy a house, but I get it 100% on a mortgage. Is that mortgage an asset or a liability? Anybody? It is that. Yeah. And so your mortgage has to go in the liability section, but exactly on the left side, you now own the house. So your assets on the left side are the house that you now own. On the right side, it's the mortgage that you owe. You're guessing correct. So the mortgage is the liability, Lena, because it's what you end up owing, right? Because you're gonna have to pay back your mortgage. That mortgage isn't yours, it's a debt to someone else. So the mortgage is a liability, But in exchange, you get the asset, which is the house. So the asset is the house, the liability is the mortgage. Cool. Again, these are not intuitive concepts. If you are understanding this, you should be really happy with yourself, because it's not easy. This is not easy, and it's really cool. I think it's really great that you guys are answering these questions well. So thank you very much for participating. Walking through liabilities, it's the same thing. You have your near-term liabilities, so accounts payable, instead of being things that are, instead of being someone's going to Venmo you in the next week, it's you owe someone a Venmo and you're probably going to pay them the next week, so you owe that debt. So even though you haven't actually paid them, you record it as your debt. So accounts payable is what that is. It's essentially the short-term things that you owe. All of these other things in liabilities are just fancy ways of saying debt. These are different types of debt. They get a little complicated, so I'm not going to go into them. But the general takeaway is liability is what you owe. And then equity, as we discussed, is what's left over. And so that is the balance sheet. So with this, we can know what a company has, what a company owes, and what a company has in terms of equity as a result. Any questions on the balance sheet? Great. We'll move on. The income statement. So as I said before, the income statement is the most important statement of the three. Why? Because it's the one that investors and financial analysts care the most about, and it's the one that's the most helpful when it comes to understanding how the equity is doing. Oh, Lena asked a question. So is the equity the most important thing investors want to see? The answer is no, because the thing that when an investor looks at a balance sheet, the question that they're answering is, does this company owe too much money, right? If you have like $10 of assets and then $9 of liabilities versus $2 of liabilities, you're a lot more indebted if you have $9 of liabilities. So if I look at your balance sheet and I see that you have a ton of debt, I question it, because I'm like, wow, you guys have like a lot of debt on your balance sheet. It's not important when it comes to gauging how the company is doing. It's important when it comes to understanding if the company is over indebted, under indebted, or if it's, as they say, capitalized. Capitalized is, do you have the cash to pay back your debt? And so the balance sheet, the most important thing investors want to see on the balance sheet is that you have cash and that you're able to pay back your loans and that your liabilities aren't too large. The most important thing investors want to see, of course, the most important thing investors want to see is how much money, how much cash is this entity, is this business producing, right? The income statement tells you exactly that, which is why investors care a lot about it. Not only do they care a lot more about it, they get more in depth. And here's where you can really start understanding a company. And here's where we will walk through line item by line item. So the first one is your revenue. Easy. It's how much money you're making. Easy. Cost of goods sold is your marginal cost to produce an additional good. And so there are two types of costs. There are fixed costs and there are recurring costs, variable costs, right? I'm sure you guys have heard, or hopefully you've heard of this, but if not, it's important. So fixed costs, you start a lemonade stand and you buy a sign, and that sign is a fixed cost because you pay for it once, you make the stand, and then it just sits there forever until you need to reinvest more capital, like we talked about in the cash flow statement, but that's for later. Exciting. I know I'm getting ahead of myself. I'll slow down. Variable costs are the lemonade powder, right? For you to make an additional $1 of lemonade, you need to have some additional amount of lemonade powder, and you will always need to buy additional lemonade powder if you want to make the lemonade and make money off of it. That lemonade powder is a cost of goods sold. Cool people like, was it Parsa or Lena? Parsa. Cool people like Parsa will call them COGS. It's the cool investor way to say cost of goods sold. But if you as a high school student go to like an investor and you're like, wow, the COGS is really good, they're going to be like, does this kid actually know about income statements? And you're going to be like, hell yeah, I do. It's going to be fun. Your gross margin is the difference between what you're making and then your variable costs. And so what it's capturing is your income after all of the lemonade powder and like the incremental variable costs without accounting for any, right? That gets you your gross profit. or gross margin. It's called gross margin here. It's typically known as gross profit. Gross profit is just your revenue minus your costs. The next one is your operating expense. So everything above gross profit as an expense is marginal, like we talked about, such that you'll continuously need lemonade powder as you sell more lemonade. When we think about below profit line, you stop thinking about the variable cost to produce and you start thinking about everything else. So what does that mean? Operating expenses are expenses that don't have to do directly with your product, but that you need to run the business, right? Operating expenses include administration, salaries, wages, labor, basically the manpower usually, that doesn't have to do directly with making the product, but has to do with running the business, right? Depreciation expense. So, okay, depreciation, I'm not going to get super into it unless you guys want to get super into it. I'm happy to explain it if you'd like, and if it's helpful. I'm not going to go super in depth by default, but all depreciation means is it's an expense that takes away the value of an asset that's dying over time. If I have a car and I buy a car today for $10,000 and I assume that car is going to last me 10 years, theoretically, every year, my car is $1,000 less because that $10,000 that I paid gets basically amortized. It lasts those 10 years such that today it's worth $10,000, but next year it's worth $9,000. Then the year after it's worth $8,000, right? Because your car is worth less every year, you're taking a loss. And that loss that you're taking because your car is getting crappier is your depreciation expense. Depreciation expense extends to your buildings, your tractors, your heavy equipment. Anything that breaks over time will have a depreciation expense associated with it. And so yeah, that's essentially all it is. Let's play a game. What I'm going to do is I'm going to name an expense, and I would love for you guys, I would love for you guys to, on the chat, reply with which expense you think it might be. Is it the COGS? Is it an operating expense? Or is it a depreciation expense? I'm going to get creative because I'm bored and I want to have fun. So let's think. What's a cool expense? How do you calculate depreciation expenses? Like I just told you, right? So you have to find the initial worth. So if the car is worth $10,000, right? The lifespan, which in our math problem is 10 years. And then if you assume straight line consistent depreciation, if you last 10 years and the value is $10,000, then you are losing $1,000 a year. You want to calculate depreciation, and that's how you calculate depreciation expense. Oh, that's helpful. But let's do the cost game. So McDonald's, your burger patties, what are those? COGS, operating expenses, or depreciation? Yes, COGS. Good job. Thank you. Hey, Esteban, great job. Thank you, Parsa. Cost of gods. That's a new way of saying it, but honestly, I might actually copy it. That's hilarious. And then somebody said Call of Duty. Great. No, I'm kidding. COGS. Great. Okay. How about, let's see. Oh, your lemonade stand assistant, little brother or sister, or they. Exactly. Alan, I love it. Good to see your name. Mari's coming back, and then Parsa and Lena, the usual suspects. Awesome. Okay, great. And then you having to buy another lemonade stand sign because the initial one broke. COGS, operating, or depreciation? There you go, depreciation, exactly. All right, you guys get it, awesome. When you subtract the operating earnings and the depreciation expense from your gross profit, you get your operating income or your operating earnings. This is probably, I would argue, I'm not gonna die on a hill for it, but I actually kind of fairly believe this is the most important number in financial statement analysis. The cool investor savoirs don't say operating income, they say EBIT, which stands for earnings before interest and taxes. The operating income is one of the most important figures in financial statement analysis because it is essentially the ongoing income of your business, of your lemonade stand, without thinking about things outside of the operations of it. You're not thinking about money that you owe to other people. You're not thinking about cash you need to inject. This is the income of the business if you account for all the expenses and income that happens on a day-to-day basis, recurring, ongoing, day-to-day basis. EBIT is really, really important. You'll also hear people say it's a proxy for cash flow. All it's saying is it's a good indicator of around how much money this thing is making. So yeah, EBIT is important. EBITDA is also important. All this is just basically it's your operating income, but you're adding back your depreciation. I'm not going to explain why because it's really complicated, but the article that you have at the end of your materials will definitely answer that question. And by the way, if you read that entire book, you'll definitely know about financial statements. I like it a lot. It was like what I used to study. Cool. After your operating income, you have interest expense. So here's where I'll ask you guys a question here. How much debt you owe today? Is that a static or a in motion figure? How much debt you owe today? Oh, it's constant. It's usually, so depreciating process, by the way, I just saw your question. It can be either. The important thing is that the treatment is stated. So typically, what you'll typically see is something called straight line depreciation, which is constant, correct? Yeah, so how much money you owe today? Is that in motion? The answer is no, it's static, right? So if you look at the balance sheet has what you owe, right? And that's static. So how much you owe today is a static motion. Now, how much interest you pay on the debt that you owe, is that static or in motion? Exactly, it's in motion, right? So your debt is the static, how much do I owe on my credit card? Your interest expense is the $30 that those hooligans take out of your account to pay your interest. That is a motion expense because you're paying interest over time. So does the interest expense go in the balance sheet or the income statement? Balance sheet or income statement? The answer is income statement. Yeah, exactly. Thank you, Leon. So your interest expense, now, the reason your interest expense, people don't care about it and they think operating earnings is important is because your interest expense is reflective of how much interest you have to pay, but it really doesn't have anything to do with the business, right? Like how much you have to pay your credit card back because you wanted to buy another sign for your lemonade stand doesn't really capture what your lemonade stand makes. It's just some debt that you have to pay that you use to be able to finance your lemonade stand. And so interest expense is typically included after EBIT, and it's typically not as important because it's not as reflective of the operations of the business, but rather the interest that you're paying on the debt that you owe. And then you get to your net income. So after you pay your interest and your taxes, you get to your net income. Your net income is probably the second most important figure after your EBIT or operating income. And that is your income statement. That is how you can understand the revenues of a company over a period of time, as well as their expenses and how they're doing that. If you go into a company's 10K, a public company, they will literally take, for example, that COGS line, and they will break it down and say, we spend it on X. Understanding the body, in this case, the company. I'll stop there for any questions for like 10 seconds, and then we'll move on to the cash flow statement. Thank you for hanging there, guys. You guys are all doing a great job. I really appreciate the participation. Great. The last one is cash flow. Cash flow, I would argue, is the least important financial statement of the three. Why? Because it factors in a lot of expense and cash needs, and basically your cash flow statement captures all of the cash movements outside of the ongoing operations of the lemonade stand, right? So investing in something, taking a loan out, like anything has to do with like that doesn't have to do with the operations, you'll see a lot. Well, that's usually the statement. Sorry. Okay, I'm confusing you. Let me take a step back real quick. Forget everything I said. Cash flow statement is another motion statement that's divided into 3 parts. 2 of those 3 parts have nothing to do with business, the business itself. 1 does. Cash flows from operating activities is the one that has to do with your business, right? I'm not going to go into like these specific adjustments because it gets a little bit more complex in terms of understanding like why they're there and why you're adding or subtracting, etc. But basically, this is just your cash movement from your operating activities. And then the last 2 are the ones that have to do with outside of your business. The first one is your cash flow from investing activities. So this is when you buy another lemonade stand, invest to like create a new cool lemonade packet or whatever, but it's not part of the day-to-day operations. You're just investing in the business to like do one fixed cost and then like have it improve forever, right? The second one is financing activities. So this is cash that you get by borrowing, right? So the static number is how much debt you owe. The motion number is you taking out debt, so you have more debt, and you paying your debt back, right? You'll see the motion number. So like the motion number of paying your debt back and raising more debt is in your cash flow statement. How much you owe at any given point in time is on your balance sheet, right? So that's the cash flow statement. I won't go too much further than that. It's like a little more complicated. I wouldn't go crazy on trying to fully understand it, but it's important. It's just not as important as the other 2. Going back to this page, things to note after our discussion. I really like this drawing because it shows you how everything's connected. Your net income becomes the beginning of your cash flow statement. The difference of your cash at the beginning of the period and at the end of the period actually ends up being your cash over here. And so what you'll start seeing over time, and I'm not going to go through all these because there's like a ton of linkages, but you'll start seeing how the static and the motion connect so that you can start understanding, oh, net income flows into the cash flow statement, this flows into the other thing. That is the next step, I would say, in terms of understanding financial statements. I'm not going to go in depth because I think it's a little complex. But yeah, these are your 3 financial statements. For me, as an investor, this for me is not my job. This is like a book for me. This is something that I read or I look at and I say, oh, I get this company. Oh, they spend a lot of money. They have very low margins. It can't be a tech company. And you kind of start really picturing the company and painting a picture just by looking at these statements. But the statements themselves are not my job. The statements are like the company's snapshot that allows me to then analyze the company to then do my job and think, okay, you know, do I think the company could make more money? How much more? Why? And that's more on the investing side, and I'm happy to talk about that. But yeah, those are the 3 financial statements. I think we have definitely some time. So I actually left some topics here that we can talk about. These topics are a little bit less focused on financial statements and a little bit more focused on general corporate finance. But happy to talk through if there's anything here that you guys would want to learn more about, or if there's stuff that like you were like, oh, I've always heard about investment banking, but I'm not really sure what it is. Happy to talk through that. So I'll take a stop there and happy to answer any questions. Great. I want this to end at 4:45, so I'm gonna have some fun with you guys and like teach you some core finance concepts. So one that I really like is the time value of money. Questions? Oh, here we go. Investment banking. Great. Yeah, we'll talk about investment banking. So investment banking is, what is the best way for me to explain this from an analogy perspective? You're McDonald's again. I don't know why I'm thinking McDonald's. We can do investment banking. We can do just stock price matter. Great, awesome. Let's say you're McDonald's and you want to open 100 new stores in Kazakhstan, right? But you don't have the money for it, and you need to raise debt. Well, as a human, typically you would go to a bank and say, hey bank, I need to raise $10,000 so I can buy this ridiculously overpriced large TV, right? And the bank will be like, okay, let me check your credit score, let me whatever, let's check you're good, and then we'll give you the loan. With McDonald's, it's actually the same thing. It's just that they don't need $10,000, they need $10 billion. And so no bank is going to have $10 billion. Like if you walk into a bank and you're like, can I borrow $10 billion? They're going to tell you, please leave. Like, who are you, right? What you need to do at that point is you need to find large pools of investors that do have $10 billion and get them to give it to you, right? And so what investment banks do is they are the bank that finds investors that can provide debt at the level of millions that a simple bank can't provide, and they connect them with companies. So McDonald's says, I want to build 100 McDonald's in Kazakhstan. I need to raise $10 billion. I'm making up numbers, by the way. You would never raise $10 billion to start 100 McDonald's. And if any of you did that, like, don't do it. Making up numbers. But what I'm saying is, they'll say, wow, we don't have that money on us. We need to raise 10 billion of debt. So they go to an investment bank, Goldman Sachs, and say, hey, we need $10 billion of debt. Can you help us? Goldman says, no problem. They go to all their investors and say, yo, McDonald's is building out McDonald's in Kazakhstan. They need $10 billion. They're good for it. We've been working with them for 10 years. They make money. They're profitable. They'll be able to pay this back, no problem. Are you guys interested? And then some investors will say yes. Some investors will say no. But eventually you hope that enough investors say yes so you can raise 10 billion of debt. And that's what investment banks do. Investment banks find capital and investors to put into companies. It gets a little more complicated than that, but anything that has to do with like companies interacting from a finance perspective or investors investing or lending, it would require a bank. We'll go in order. I'll go in order with the questions so it's fair. But in terms of divisions, there's a lot of divisions. I think that the biggest way to cut the dice, to cut it there, is industry. So investment banks will split up by coverage. So you'll have tech bankers, you'll have financial institution bankers, you'll have bankers that only work with natural resource companies, bankers that only work with healthcare companies, and they kind of divide like that. And I would say that's the primary way that investment banking teams are divided. Does stock price matter? The answer is no. The reason why is what matters is market capitalization. Market capitalization is a really fancy finance term for how much is this company worth? Like, what is a fair price at which an investor can come in and buy this entire company out, right? The two variables there, so your market capitalization, the equation for it is the number of shares times the stock price per share. So if your stock price is $10 and you have 10 shares, your company is worth $100, right? But if your company, let's say your company has stock price is $20, but there's only 5 shares. In that case, it's still $100. So both market capitalizations are equal, even though the stock price is double for one. Why? Because the denominator, aka, or the other number, aka the shares, have to also lessen. So it's not about whether stock price is high or low. It's about where it's relatively moving up or down. As an investor, what level of liability expenses in terms of earnings of a company do you look for? What is acceptable? So I work with tech companies, so we don't like debt. I think if we see debt, I think you're probably at a stage where you're no longer a good fit for us. So personally, as a tech investor, we typically will not look at, we would rather not go with leveraged companies. But if you're an investor that works with industrial companies or with agriculture companies or whatever, you'll typically look at your debt to EBIT ratio. You guys remember EBIT? So basically you're saying, what is the debt, my debt load, how much debt do I have relative to how much money I make, right? If I have $100 of debt, but my operating income is $50, I know I could technically pay that off in 2 years, right? And so my debt to EBIT is 2x. $100 owed over $50 that you make every year, EBIT. And that is 2. That is called a coverage ratio. And typically you want that to be between 2 and like as low as possible, but not higher than 3. So if you are owing $300, but your EBIT is only $10, I'm not investing in you. 0% chance. That is way too, because you're making money that is not even enough to pay back the debt that you've taken out, which is trouble. What's the difference between investment banking and corporate finance? Nothing. They're the same thing. Corporate finance is investment banking is like the cool fraternities way of saying corporate finance. Not that you guys know about fraternities, or you will. Point being, you got right. When the banks go to investors, is this usually private equity firm? Yeah, in many instances, it's private equity firms. Sometimes it's pension funds. Sometimes it's university endowments. Sometimes it's nonprofit endowments, right? But private equity is definitely one of the biggest types of investors that banks will go to. That is a good question. Time value money. Let's go. Okay, cool. If I told you you can have $1 today or $1 tomorrow. Okay, sorry. Let me rephrase that. What's worth more, $1 today or $1 tomorrow? Anybody want to answer it? $1 today, she says. Okay. All right, we got 3 todays and 1 tomorrow. Does anybody want to give a brief explanation for, does it depend? The answer is it does not depend. This is a hard and fast rule. The answer is today. Why? If I give you $1 tomorrow, tomorrow you will have $1. If I give you $1 today, you can put that money in the stock market. You can, put that money to invest in yourself. You can basically invest in maybe a curriculum where then that gives you a job so you get hired. The point being is that with that $1, you're able to invest it today such that tomorrow it is worth more, right? So you would always take $1 today over $1 tomorrow because of the time value of money. And the time value of money simply states that over time, the value of your dollar in the future is lower because you could have invested it for a higher gain before. That wasn't intuitive. Let me try to give a better explanation. Trying to think, what's like a really, I'm not gonna actually, it gets a little more complicated, but the overarching takeaway is that today is better than tomorrow, and it's because you can invest it today such that it will be worth more tomorrow. Cool. What should we do in university to prepare for getting into investment banks like GS? And do they recruit people? Yes, they definitely recruit people that are non-US. What about inflation? Doesn't that increase the value of money? It could. It's true. But it hasn't. But you're right. That's a good point. It could. It just hasn't. But if there was like massive inflation, then yes, $1 tomorrow would be worth more than $1. Actually, yeah, it would be worth more than $1 today. In terms of investment banking recruiting, I would say your first year, you want to get straight A's and you want to keep up a GPA of like a 3.5 or above, ideally, in an ideal world. If it's a little lower, I think it's fine, but to apply, but that's kind of definitely the goal. Get like the first year really focus on grades. I would also highly recommend getting involved. I would recommend basically getting involved in 2 to 3 extracurricular activities that you're passionate about, and then look to like get leadership positions in those activities your sophomore and junior year. Why? Because investment banks differentiate you as a candidate by looking at your extracurriculars. If they see that you are the president of a student club, they know that you've dealt with funding, that you've dealt with budgets, that you've emailed back and forth, that you've reserved spaces, that you've coordinated events. And believe it or not, a lot of those skills are really transferable to investment banking because you are coordinating a lot, you're going back and forth a lot, you're managing different people a lot. And so a lot of those intangible skills are trained in your extracurricular activities. And so I would recommend A, good grades, and B, making sure like you really get involved on campus. That said, I think that wraps it up. Thank you guys so much for attending. I think this was pretty helpful. I hope you guys found this helpful. Again, when you were applying, you already knew that you wanted. No, I didn't actually. I got lucky. I didn't know I wanted to do investment banking until my sophomore year. I just had really good mentors who like gave me a lot of really great advice and helped me out. And that's kind of why I do these things, because it's like, you know, I think about them and I think about paying it forward. And this is my way of like kind of telling you guys so that you kind of know what the roadmap is. Like you guys already kind of have a better idea than I had when I was your age, right? And so that's what this is all about. Yes. Oh, thank you. I'm glad you enjoyed it. No, I really appreciate it. By the way, you guys were really, really great. I think you were really you heavily participated. I very much enjoyed this. This was fun. So it was great. Oh, thank you. Cool. So I will toss it over back to Carrie, and I'll be back to do the Excel course. It'll be a little bit more interactive, but also really fun. Could be also helpful for you. So, you know, I'm not saying you should or should not attend, but you would learn a little thing or two. But anyways, thanks guys, and we'll stay in touch.
Absolutely. Thank you so much, Pablo. That was fantastic. I know a lot of people with the global schedule weren't able to attend, even though we had tons and tons of registrations. So I know lots of people will be looking forward to receiving this recording and following along in the workbook. So guys, you definitely don't want to miss Pablo's Excel 101 coming up. You all would have invitations. If anybody needs any information on that, please go to the Case Comp website under the event calendar, or you can always email info@casecomp.org or connect with us on Facebook or Instagram. Awesome. Thank you so much, Pablo. That was great. You were such a great presenter, so interactive, guys. We hope you all enjoyed it. Everybody take care, and we will see you soon. Thank you.
Bye, guys.